On today's Big Money Bingo, we're going to be looking at why YieldMax ETFs are absolute garbage and why you should stay away from them. Even though they sound like the coolest thing ever, they actually are a horrible, horrible, horrible investment unless learn why.
If I have to see one more dividend influencer pitching another 50, 80, even 100% passive income opportunity with covered call ETFs, I'm going to lose my mind. Funds like PLTY, HOOY, Misty, and ULTY from YieldMax are exploding in popularity because they look great on social media. People are flashing their $3,200 monthly dividend income on Twitter and Instagram and grim reapering people into these ETFs. The pitch is simple. Buy these extremely high-yielding instruments, and you get to retire early on passive income. Skip the traditional 4% yield dividend ETFs for boomers. Grab the YieldMax ETFs, and you'll never have to worry about money again.
So we talked about this a little bit last week on a video we watched from Professor G, and it was the first time I had heard of YieldMax ETFs. And we really got into the topic about how, as sexy as it sounds to be paid a dividend, if the stock price is going down, for example, we looked at UPS. UPS had like a 6% dividend, I believe it was, maybe 7%, but the stock's down 30% year to date. How does that help you? You may have collected 7% as your dividends, but your investment's down 30%. That is a total huge net loss, right? That's like saying, I have this great rent house in a city where the Texas Roadhouse just moved out, and I get income every single month, every single quarter. It's great. But yet, because as you know, Texas Roadhouse is the best indicator if a city's doing well or not. There is no better indicator out there, okay? And if Texas Roadhouse moves out, then all property values drop by 30%. Is that rental income really worth the drop in value by 30%? I would say not.
It briefs well, but it's snake oil. And I say this not as an anti-dividend guy. I do not believe in dividend irrelevance theory. I have plenty of money in actual dividend ETFs like VIG, and I completely understand the appeal and value of dividends. But these ETFs that you guys are flashing at each other, this is not what you need. Let's look at an extreme example. Here's Richie B on Twitter getting all excited about his dividends from YieldMax ETFs. He's got emojis, he's kissing his wife next to stock charts. This looks like a great time. I'm happy for him. Here he is showcasing his $22,000.
Okay, let's pull up the charts. I see Price Hunter talking about ULTY. Let's take a look over at ULTY's chart real quick, because I would bet it's not going to look very good. Let's look at it real quick. ULTY.
Dividend from PLTY and a $1,000 dividend from ULTY. This looks cool, right? Everybody wants to be like Richie and get paid 23 grand a month to do nothing. But I tell you now, these investments are not what they seem, and neither are Richie's distributions. If you put your money into a high-yield covered call ETF, you are racing to get your investment back before the yield tanks and the share price drops forever with no prospect of recovery. I'm going to just...
But wait. It should go back up, right? Wait, who put that up? Daniel. It should go back up. It should go back up. Right? To Zachary's point here, the promise of YieldMax ETFs felt very similar to the promise of selling options, which I've talked about before, is an exceptionally dangerous game. They both got him for a little bit. Zachary, you're not alone, dude. You're not alone.
Destroy every argument about these products being good investments. If you're a connoisseur who thinks that you're going to retire on $100,000 invested because YieldMax is going to give you 80% returns for life, put your bias aside for a minute and hear what I have to say. I'd also like to thank Mumu for making this video possible and awarding...
We will skip all ads, by the way. And we need to get some points on the board, okay? So help me out here.
Up to 1,000 dividend ETFs. They say, I'm getting $900 from Misty, $700 from PLTY, $800 from Hui, and so on and on. They speak as though they're getting dividend from the ETF. Here's Richie's total year spreadsheet. Take a minute and gawk. It is a fun spreadsheet. But Richie also gets upset when people criticize his investing. So I'll say now, Richie, I have no beef with you. I'm using you as the example specifically because you share everything, which makes it easy to find information. I'll leave your Twitter link in the description so you can get more follows. Now, look at what Richie is showing. Tens of thousands in monthly dividend from Misty, and he also holds PLTY, Hui, and ULTY. I want to reframe the logic here. If you full port into Misty, don't look at it as putting your whole portfolio into shares of Misty. Look at it as putting your whole portfolio into covered calls on Strategy Incorporated, previously known as MicroStrategy. In a covered call, you or the fund that you manage owns the underlying stock, in this case, MicroStrategy shares. MicroStrategy doesn't pay a dividend on its own. So to create income from these shares, you sell a covered call. That means you sell someone the right to buy these shares from you at a particular price at some point in the future. And for agreeing to that obligation, you receive cash on the spot. For example, if MicroStrategy is trading for 337, then when you sell a covered call, you may give someone the right to buy MicroStrategy shares from you next month at the $340 mark. And then you'll receive $1,970 in cash immediately for agreeing to this arrangement. If MicroStrategy goes to $400, you're still selling shares at $340 because that's what you agreed to. If MicroStrategy is $200, the person who bought the call from you will just ignore the contract and doesn't have to buy the shares at $340. Either way, you keep the almost $2,000 in cash they gave you for agreeing to that arrangement in the first place. The principle is solid so far. You get to own the stock and you make income off the covered calls. Now imagine being Vanguard with 18 million shares, with the ability to sell covered calls for $3.9 billion of premium each month, and you can see why a company would want to market a covered call ETF. Retail traders want a piece of that premium. But Vanguard doesn't manage MISTY, that's the MSTR covered call ETF. That would be YieldMax, and YieldMax doesn't have money like Vanguard and can't afford all those shares. So to add some leverage to the situation, YieldMax doesn't just hold shares of MSTR and sell covered calls against them. That would be expensive to buy all those shares. So instead, they use a synthetic position to add leverage. That allows them to sell more at-the-money covered calls and generate additional premium versus just straightforward covered calls. But in exchange, they're still giving up almost all of their upside. If MicroStrategy shares go higher, MISTY doesn't rise. But if MicroStrategy goes down, MISTY still drops with it.
Oh, so it's a flawed concept from the beginning. It's literally never going to work, is what he's saying here.
Of that premium they collect for selling the covered calls, YieldMax takes their management fees and distributes the rest to MISTY shareholders as dividend or return of capital, which we will expand on later. So what do we have so far? We have an ETF that uses a synthetic long position as collateral to sell covered calls and collect premium, which it then kicks back to its shareholders minus a management fee. It sounds straightforward enough, but let's talk about why this is not a good deal for the shareholder, even the long-term income-focused investors that gobble these things up. Besides, if you need to make a quick buck, I've got another solution for you.
No ads. We're going to skip ads.
The first problem with these ETFs, and the one that everyone wants to ignore, is that they will always underperform their underlying stock over any appreciable time period, even after you include the dividends. These instruments sell at-the-money covered calls with 30 days to expiration. They leave very little room to the upside to grow their share value if the underlying stock rises. So if Palantir is trading for $150 and PLTY is selling a covered call at the $150.
Let's look at the PLTY chart real quick. Oh, that's the end of the data. Okay. I mean, it's been sideways. I mean, it looks like that's the best case outcome here is going sideways.
Strike to collect the maximum amount of premium. Palantir may go up to 180. PLTY shareholders are not participating in that rise, and instead they only get the premium that the fund collected 30 days prior. To get out of that in-the-money short call, PLTY will roll all of its positions, often taking a loss, which eats into its share price. The share price is down 16.3% year to date, while Palantir is up 104%. On the other hand, if Palantir drops, PLTY's share price drops alongside it. In no way can PLTY sustain share appreciation.
That's what I was just saying. It sounds like there is an impossibility of your asset value rising. And this makes a great investment. How? Because you get paid the dividend. Basically, what they're saying is they're going to take $100. Like imagine you invest $100. They're going to give you 50 cents of it back. Sure. Okay, awesome. I made 50 cents. But yet your asset price has gone down by 50 cents, maybe more, maybe 48 cents, give or take, right? Next year, they're going to give you 50% of the 48 cents. So they're going to get 25 cents back. Okay, cool. And so while it feels like, oh, I'm making income, your actual investment is going down in value. It's absolutely garbage. Yeah. If it looks too good to be true, it probably is. Yeah. This is crazy. By the way, We will be having bingos today. I saw Manny saying there's not going to be any bingo. No, I will make sure that we follow the trend of previously having bingos, because we will make sure that this big money bingo chart breaks out, and we will cut our losses. Okay, I will make sure of that happening. But I mean, just in case I said anything, right, I want to make sure that I wait in cash until that point.
And keep in mind, this decline is during a massive bull market when Palantir doubled in price. If you want an example of what happens when the underlying stock is not shooting up, let's look at TSLY, the covered call ETF for Tesla.
Yeah, that's definitely a great investment that I would want to buy. Looks like it has lots of momentum behind it. Man, if only somebody knew how to reduce their risk. Oh, wait a minute. Are several things going up in big money bingo? Oh, jeepers. Let me catch up real quick. I am so behind. I feel like that random guy on the internet said something about following the trend. What else did he say? B1, B3, I5. Oh, man. I can't believe that this random guy just said random words that happen to be randomly on the bingo space over here. Goodness gravy. O3 cut losses. Let's see. Did I get all of them? Did I get? I seriously want to know. Did I get all of them? Right. Random fire. It might be a blackout. We'll see. That would be so inconsistent and have no discipline if we happen to end up with a random blackout. But you got to trade what you see to get there.
Tesla is down 17% for the year, but TSLY is down 45%. Why? It's because these at the money covered calls allow no room for the stock to appreciate in share price. Any share price decline in the covered call ETF is effectively permanent unless the stock goes parabolic, and those spikes tend to be short lived as the position rolling causes a loss to net asset value, or NAV, and dividend distributions drop the share price on ex-dividend day.
Habibi, I don't care about share price. I'm an income investor. I'm not here for growth. I only care about the dividends and total return, not share price.
I hear.
That's so funny. But this random guy over here, I think that a lot of people feel that way. It's really a thing, right? They think that there's no point in finding stocks with strong breadth or pushing for higher highs, right? They certainly aren't going to use a stop loss whenever they're buying these ETFs, because why would they, right? We're only looking for dividends in this case, right? We don't care about the asset value. We just want the income. Bro, it's literally setting your money on fire, right? Man, if only they had like entry signals or something that would help them keep the right mindset. Oh, man, and I agree. Yeah, all stocks are bad. I don't know. I may have said a couple things over here. Let me know in the chat if I said a couple of those things, because I just don't even remember. I just don't even remember. Steve says G1. Did I say G1? Oh, I might have said G1. I don't know. I kind of lost track of what I was saying here. Andrew says G4. G4, give me a break. Did I say G4? Maybe I did. Maybe I did. Let's see. Let's put G4 over here. Trying to help you guys out, by the way. Andrew said 05. 05? No, surely not. I definitely wouldn't have said 05. No. For sure not. For sure not.
Here for growth. I only care about the dividends and total return, not
YieldMax only works until they run out of money. That's right.
share price.
I hear you. And this is where we encounter a second problem. These distributions on these ETFs will continue to decline. High Yield Hustle is telling everyone that $50,000 on PLTY and HUI are going to pay you $50,000 a year in dividends for 100% annual return. But he's wrong. This is simply not the case. All of these ETFs will pay continuously lower and lower dividends every year, with the occasional spike around earnings when covered call premiums are inflated.
Do you know why they pay lower and lower dividends every year? Because they base the percentage on the price of the stock. So if the price of the stock, this is called an asymptotic curve, big word. When a curve starts up high and then moves down more and more and more towards zero, but doesn't actually cross zero, that's called an asymptotic curve. Now, it starts at 100, goes to 98, goes to 95, goes to 96, all the way down until it reaches a point down near zero where it's like 0.01, 0.009, things like that, right? And they're basing the percentage yield on the price of the stock at that time. So it's only going to go down. It's never going to go up. Yeah, Bernie Madoff would be proud. Yeah, this feels very much like a Ponzi scheme for sure. You know, if only these people knew how to let their winners run, right? If they had journaled their trades and let their winners run, maybe they would know what they're doing here.
Let's look at TSLY for a particularly good example of this. When TSLY first came about at the end of 2022, the ETF was paying about $2 a month in distribution. Now here we are in August 2025, and the last dividend was 30 cents. That's 15% of what it used to pay, about 1/7. You're now getting in about 7 months what you used to get each month. In fact, the dividend will probably drop more over the next 7 months. So it'll take even more time than that to collect what you used to get monthly. If you add up all the dividends that TSLY has paid since that time, you get $34.26 for a total gain of $1.78. A stock that rose 90.5% has you up 4.4% pre-tax.
Sick deal, right? Stock going up like crazy. You've missed out on all of it because you wanted to collect income. And your total net gain in your account, $1.78. Sweet deal, bro. Great strategy over there. If only they had figured out how to reduce risk. Oh, wait a minute. Is that our first bingo on the board? Our first bingo? Okay, man, that would be so crazy if we had more than one bingo. Wait a minute. I feel like I said strong breath earlier. You guys tell me in the chat. I may have missed that one though.
A 4.4% pre-tax return over almost 3 years underperforms a high yield savings account. If you really are an income investor, don't tell me that you're good with this because you only care about monthly dividends. TSLY.
Yeah, it really is stupid. It really is stupid. It's robbing Peter to pay Paul, right? You're not getting ahead in this game. Right? There is very much a what am I trying to say here? There's very much the mentality of, well, if it's paying this much money, it must be a great investment and it can't go down anymore, right? In fact, like that's a real reality check that a lot of people get in the market is when they say it can't go down any further. This is a great stock, right? It's got the whole sector has all kinds of strong breadth for it, right? I've bought every dip that came through, right? Even though I tell you guys don't buy the dip. It's a reality that people honestly feel like they are one-upping the market. They figured out something when something like this comes along, and yet at the end of the day, they're losing their shirt over it. Wait a minute. Did I just say strong breath? Oh, no way. Did I say O4 and N2? Wait, O4? I know for sure I didn't say exit signal. I was purposefully not saying that one. N2, I did say don't buy the dip. That's right. I think I might have said, did I say I2? Jean-Louis, did I say I2? I might have said I2. Oh no, is that right? Another bingo? Two bingos on the board, man. Let's see if we can go for 3.
Is showing you exactly what happens when these massive green seasons on MicroStrategy, Robinhood, and Palantir go away. To pick on Richie a little bit more, he's showing you his Misty distributions. He's had 15,000 shares since March, and although we don't know his basis, we know that Misty was trading for about $25 on May 1st. So 15,000 shares was worth $375,000. It's a pretty sizable position. Now on August 20th, 15,000 shares of Misty is worth $255,000. So he lost $120,000 of share value during this window. Conveniently, Richie flexes exactly how much dividend he received from Misty since May, which is $93,935.
So he's down less than the amount of the dividends that he's being paid. Yet this is brilliant. I'm so smart for having all these dividend payouts.
So these screenshots of massive dividends come at the cost of about $26,000 in losses, and he still has to pay tax on the distributions. Now,
great point. I didn't even think of that part. It gets even worse. But wait, it's worse.
No shade to Richie. This table looks great. It looks awesome to pull $20,000 a month in dividends. But even after accounting for all those dividends, he still lost $26,000. And to be fair, it looks like he traded in and out a little bit earlier this year, so we don't know his total gain and loss. But if you look at how these dividends are trending, each month's dividend is only going to go lower. Misty has sustained its payouts better than most YieldMax ETFs. But there is no denying that these distributions are not a promising trend. We might see spikes in earnings months, but that downtrend will continue. Misty will eventually be just as smoked as TSLY.
Mikey, you're overthinking. Mashallah, some of these ETFs are up 200% after the dividends. Why do you got beef?
Even where it's not the case that the covered call ETF drops significantly, we can still see another problem: how these ETFs grossly underperform the underlying stock even when they do return profits. Now remember, the synthetic position of these covered call ETFs means that they have exactly the same risk profile as someone just trading covered calls. That means that when the underlying stock drops, the covered call holder loses value too. Meanwhile, covered call sellers have very limited upside. Let's compare Palantir to PLTY, including all dividends paid. Here's the chart since PLTY's inception in October 2024. The y-axis shows the Palantir price, while the PLTY line scales with percentage change, with dividends included. Yes, if you bought PLTY, you made money. Putting your money into Palantir covered calls in October 2024 was a winning strategy. But look how badly you've underperformed Palantir. You're about 30% behind the underlying stock. And don't make the mistake of believing that PLTY is somehow defensive and that it will therefore do better during a downturn than Palantir. Look at the January to February dump and every dip after that. PLTY is more or less mirroring these declines. Maybe to a very minor extent, PLTY loses less in total return, but remember that this chart is including dividends, which will spike during downturns because of higher premium. If we're taking a high-flying stock holistically, this 30% underperformance is not worth the very minor outperformance during downturns. Here's another example. Robinhood, ticker HOOD, is up 101%, while Hui, with dividends included, is up 64%. Again, we see that significant underperformance when Hood is rising, and very minor, if any, outperformance when Hood is dropping. Misty is also underperforming its underlying, but I'm not a complete hater, and I will give covered calls credit when they're due. We do see some level of appreciable outperformance during this bear market for MicroStrategy at the beginning of the year. From peak to trough, MicroStrategy lost almost 50%. Misty, after dividends, lost a little over 41%. So this is an appreciable about 8.5% difference in which the covered call ETF did outperform, since the covered call premium offset some of the losses. But I'd also counter this by saying that I have yet to see a single person describe covered call ETFs as a hedge against declines in the underlying. It's always talked about as a passive income instrument. No one is buying Misty to hedge their MicroStrategy shares, although that would probably be a better use of this fund. We'll expand on that soon. And one more for good measure, Tesla versus TSLY. Tesla is up 74.5% since TSLY's inception, while TSLY is up 14.6% after dividends. But we see the same thing during these downturns. During the February to March Elon backlash, Tesla stock lost way more than TSLY, even though they both lost quite a bit. Be that as it may, I found exactly 0 YieldMax ETFs that both beat their underlying and finished green. All these posts about how much money someone is making off their covered call ETFs only give you half the story, because that's what looks good on social media. We've got
for sure. And if your plan is to be in a dividend paying stock, at least be in a dividend paying stock that is pushing for higher highs, right? Find a dividend paying stock that is actually going up in value. That way, the dividend is like icing on the cake. Icing on the cake. You know what? If my stock is up 10% on the year, and then I can get a 3% dividend on top of that, bro, that's awesome. Oh wait, did this random guy on the internet say I won? Oh, he certainly did. He certainly did. How about that? Oh man, we're getting close to multiple bingos at this point. In fact, let me draw a couple lines on here real quick to make sure I don't lose any. Right, we've got this bingo. Oh my goodness, hang on. Got this bingo right here. All right, I don't know an easier way to do this. Here we got this bingo going on, and then we've got this bingo going on, don't we? Wait a minute, I thought we had another bingo going on. We only got one bingo. Did I miss one? Did I miss one? I swear we had 2 bingos. Oh, there it is. There it is. G. There it is. Row G, or a column G. There we go. Okay, we got 2 bingos going on. Let's see what else we can come up with.
Dark Miner over here talking about how his 100 share purchase of Coney in October 2023 cost him $15.97 each. and the stock has since returned $14.68 in dividends. He alleges an average dividend of $1.33 per month, but if we look at the data, these dividends are dropping. He'll more likely see less than 50 cents a share from here on. Nonetheless, this is a fun statistic. If he collects another $1.30 in distribution, so maybe 3 months from now, he will have fully recouped his.
You know, Doug has a great point. A brilliant point, Doug. I don't know where you heard this from, but I think it's brilliant, right? The 10 over the 20, price over the 50 works for dividend produces stocks as well, right? Yeah. Or did he get that wrong? No. In fact, choking on myself. I believe you're correct, which means price over any moving average right there. Not quite another bingo yet. We're really close though. You know, and to Doug's point, Doug, you are quite the genius there, Doug. That really works best when we're in a bullish market cycle, because if we're really thinking about it here, that if we have a bullish market cycle, that means we've got the stocks going up in value, which would make it a lot easier to have an appreciable asset as well as the dividend on top of it. You'd be making all kinds of money, right? That's where we need to be. So yeah, let's add in market cycle. Oh, wait a minute. How could I do this? Did I just get us 4 bingo? No, we're gonna have to stop playing big money bingo at this point. We're gonna have to stop here because we just got 1, 2, 3, and then if I'm not mistaken, that also makes the bottom row a bingo. And yeah, I'm just gonna let it be like that. Look at that. We got 4 bingo. 4 bingos, baby. Let's go. All right, I'm gonna have to stop and I'm gonna have to give away some fun stuff. We got 4 bingos on the board, which means I need to give away 4 items from our merch shop, right? Over at outliershop.fourthwall.com. We got all kinds of cool stuff over there. You hit the browse all button, that way you can see everything that's going on. But how about we give away some fun stuff? Listen, you will not win. You will not win unless you've typed #outlier in the chat. You will not win. Now, going to this video real quick, I enjoyed learning about YieldMax ETFs, and I love the fact that he was as honest as he could be about how these are a terrible investment, right? We've really got to separate the dividend yield versus the investment itself. And I love to use the rent house example because it's something that we can all tangibly feel, right? If you're receiving rent, that's your dividend income. But if the house that you bought has dropped by 30% in value, that dividend income is only going to do so much for you. And man, somebody said it in the chat and it was brilliant. It was you don't pay taxes on your capital gains until you sell your stock, right? But you're going to pay taxes on the dividends. Meaning, if your stock is going down in value and you're collecting the dividends, you are actually paying taxes on your losses. There's a problem with that. Whoever said that in the chat, that was super, super smart. I really appreciate you adding that context to it. Yeah. So how about we draw 4 winners today? Does that sound good? Let's draw 4 winners. Let's draw 4 winners because that's what it's like to be an outlier. It's like being a winner. It's like being a winner. And that's why we do it. So our first winner on the board is Keisha Sanchez. All right, Keisha. Congratulations to Keisha. Let's see what Keisha's won. I'm going to copy this, shoot it over to April. Keisha has won. Let's see. I need to go to the Wheel of Fortune over here. Keisha has won. Oh, you couldn't see any of that. I'm sorry. Keisha won. Keisha Sanchez. The Monkey Hammer koozie. I apologize. There's the proof. Keisha won. Apologies. Keisha won. Congratulations. Won the Monkey Hammer koozie. So congratulations to Keisha. Hammer koozie. Awesome. Let's see who the next winner is. And we can actually see the winner this time. Keisha, yay, my first win. You're welcome. Let's see. We're all winners when we're outliers. That's right. Let's see who the next winner is. Carol Catherine, the lady with all the songs. There we go. Carol, my editor has been working on those. We'll get those put up soon. So Carol Catherine is our second winner of the day. Carol Catherine, let's see what Carol Catherine's won. Let's see what Carol Catherine has won. Let's make this bigger. Hit spin. Oh, yeah. Carol Catherine has won a Monkey Hammer hat. Very fun, very fun. Monkey Hammer hat for Carol. Monkey Hammer hat. So we got 2 Monkey Hammer things on the board. All right, we got 2 more winners. Let's see who the next 2 winners are. Make sure I go to the right page here. Draw again. Let's see. Congratulations to you, Carol. Oh, I have somebody pulling up in my driveway. I need to go meet here. Patrick Taylor is our 3rd winner. Let me copy that. Let's quickly get Patrick taken care of real quick. I apologize for having to run, but I do have a contractor showing up right now. And Patrick has won a $10 OVTLYR merch credit. And there's all kinds of stuff on there, Patrick, that you can afford with $10 OVTLYR merch credit. And then lastly, who's our last big winner of the day? Last big winner of the day. Congrats to you, Patrick. And for everybody who's a winner, be sure you email us over at support@outlier.com to claim your prize. It is Paul Martinez. Congratulations to Paul, Patrick, Keisha, and Carol. All of you are winners today. Let's see what Paul Martinez has won. Congratulations, Paul. You have won. Let's see what Paul's won. He's won a Sit in Cash and Don't F Up coffee mug. Sit in Cash and Don't F Up coffee mug. So congratulations to all of our winners, and congratulations to you for watching the greatest YouTube channel on the internet. Now, listen, I'm obviously very partial, but do me a favor. If this has helped you at all, tell everybody you know. Right? The first rule of OVTLYR, you should tell everybody about OVTLYR. And if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos, and we will definitely be talking soon.